Imagine waking up tomorrow and your savings are worth 30% less than they were yesterday. Not because you made a bad investment, not because you lost your job, not because the stock market crashed on some earnings report nobody read, because two countries you can barely find on a map started shooting at each other. That's not a hypothetical. That's happened before, more than once. And right now, in 2025, the conditions for it to happen again are closer than most financial news will ever tell you. Today, we're going to talk about war, but not the way the news talks about war. We're not going to talk about casualties or geopolitics or who the good guys are. We're going to talk about your money, your savings, your grocery bill, your mortgage rate, your retirement account. Because here's the thing nobody explains clearly. Modern war doesn't just destroy the country it's fought in, it destroys purchasing power everywhere. It rewires global supply chains. It triggers inflation, currency shocks, interest rate panics, and energy price spirals that reach into your wallet without asking permission. And the mechanism by which it does that is almost embarrassingly simple once you understand it. So let's understand it. First, let's establish something uncomfortable. The global economy is not a stable, rational machine. It is a network of promises, contracts, agreements that oil will flow through certain straits, that grain will be harvested from certain plains, that semiconductors will be manufactured in certain factories, that currency will hold its value because enough people collectively agree it will. War doesn't just destroy infrastructure. War breaks promises. And when promises break at scale, money behaves in ways that feel almost supernatural to the people caught in the middle. Let's go back to February 2022. Most people in London, Toronto, Sydney, Sao Paulo, and New York woke up that morning thinking about their commute, their meetings, maybe their weekend plans. They were not thinking about wheat futures. They probably should have been. Within days of Russia invading Ukraine, wheat prices surged 40%. Sunflower oil, which most people had never thought about once in their lives, essentially disappeared from supermarket shelves across Europe. Fertilizer prices, already elevated, went completely vertical. Natural gas in Europe went up by 300%. Some months later, it was up 600%. None of those people in London or Toronto or Sydney caused that. None of them voted for that war. None of them were anywhere near it. But they felt it, every single one of them, at the petrol station, at the checkout, on their energy bills, in the interest rate hike their central bank delivered 6 months later to try to wrestle inflation back down. That is the transmission mechanism. That is how war makes ordinary people poor without ever touching them. Let's break it down. There are 4 main channels through which a war anywhere in the world can drain money out of your life specifically. The first is commodities, the second is energy, the third is interest rates, and the fourth is the one almost nobody talks about, which is confidence. Let's take them one by one. Commodities first. The world grows food in very specific places. Ukraine and Russia together, before 2022, supplied roughly 30% of the world's wheat exports, about 20% of its corn, about 80% of its sunflower oil. Ukraine alone was called the breadbasket of Europe for a reason. That land, that soil, those farms, they fed hundreds of millions of people through the global trade system. When the invasion happened, those exports didn't just slow down, they became a geopolitical weapon. Russia blockaded Ukrainian ports in the Black Sea. Ukrainian farmers couldn't plant or harvest under artillery fire. Millions of tons of grain sat in silos while people in Egypt, Lebanon, and Tunisia watched their food prices climb into double-digit monthly increases. And here's the quiet cruelty of how commodity markets work. The price of bread in London is not set by the baker. It is set by a derivatives trader in Chicago who is looking at satellite images of Ukrainian wheat fields and calculating probability of harvest failure. The moment that trader gets nervous, the price of flour moves. The baker has no choice but to raise prices. The customer has no choice but to pay them. That is how a missile hitting a grain silo in Odessa becomes an extra 2 pounds on your grocery receipt in Manchester. Now, energy. If commodities are the food of civilization, energy is the blood. Everything runs on energy. Manufacturing, transport, heating, cooling, data centers, hospitals, all of it. and energy infrastructure is extraordinarily concentrated. A handful of choke points control the flow of oil and gas to most of the developed world. The Strait of Hormuz, about 20% of the world's oil passes through a waterway that is 21 miles wide at its narrowest point. 21 miles! If that strait becomes contested, if Iran decides to test whether it can close it, oil markets don't wait for the closure to happen. They price in the possibility immediately. Oil goes to $150 a barrel, possibly $200, possibly more. What does that mean for you? Petrol at the pump doubles. Airlines raise ticket prices instantly. Shipping costs for every good you buy, clothes, electronics, medicine, food, go up. The inflation that follows isn't slow. It isn't polite. It comes fast and it hits everything at once. This isn't speculation. We have data. The 1973 Arab oil embargo, when OPEC cut exports to countries supporting Israel in the Yom Kippur War, quadrupled oil prices in less than 6 months. The United States experienced its first recession in decades. Inflation hit double digits. Fuel rationing returned. People queued for hours at petrol stations in the richest country in the world. That was from an embargo, not even a direct war, just a political decision by producers to slow the tap. In a direct conflict near major energy infrastructure, the response is faster, more violent, less predictable. Now interest rates, and this is where it gets particularly cruel for people who are trying to save or borrow money. When a war drives up commodity and energy prices, inflation rises. Central banks, whose job it is to keep inflation under control, respond by raising interest rates. This is not generosity, this is mechanics. They are making borrowing more expensive to cool down spending and slow the pace of price increases. But here's the thing, when interest rates rise because of war-driven inflation, you are being financially punished for something you had no part in. Your mortgage rate goes up. If you have a variable rate mortgage, your monthly payment increases, possibly significantly, and you have no ability to negotiate. Your credit card interest rate goes up. The cost of any business loan goes up, which means businesses hire less, invest less, sometimes collapse. The housing market cools, sometimes sharply, as buyers can't afford the monthly repayments on the same property they could have afforded 12 months earlier. After 2022, the U.S. Federal Reserve raised interest rates 11 times in roughly 18 months, the fastest hiking cycle in 40 years. The Bank of England raised rates 14 consecutive times. Mortgage rates in the UK went from roughly 2% to over 6%. People who had fixed-rate deals expiring in 2023 saw their monthly payments jump by hundreds, sometimes over £1,000 a month. Some of them had to sell their homes. They did not invest badly. They did not spend recklessly. They were caught in the wash of a war on the other side of Europe, filtered through commodity markets, through inflation data, through central bank committee decisions, and delivered to their front door as a letter from their bank. Now the fourth channel, confidence. And this one is the most abstract, but possibly the most powerful. Modern money is not backed by gold. It is not backed by oil. It is not backed by any physical thing. It is backed by collective belief. The dollar, the pound, the euro, the yen, all of them hold value because enough people, enough institutions, enough governments believe they will continue to hold value. That belief is load-bearing. Remove it and the structure collapses. Wars, especially unexpected ones, especially ones that escalate faster than analysts predicted, create sudden crises of confidence. Investors move from risk assets to safe assets. Stock markets fall. Bond markets get complicated. Currency values shift rapidly as capital flows towards perceived safety. But here's the twist. In a sufficiently large conflict, or one that involves a major economy directly, even the traditional safe havens become unreliable. The US dollar is the global reserve currency. In almost every crisis, money flows into dollars. That makes dollars more expensive relative to other currencies, which means if you're in a country with a weaker currency, the imported goods you buy, which are priced in dollars, suddenly cost significantly more. Oil is priced in dollars. Most commodities are priced in dollars. So a dollar surge, triggered by a confidence crisis, triggered by a war you're not even near, inflates the cost of living in your country without your central bank doing anything at all. Countries in the global south have experienced this acutely and repeatedly. A war in Eastern Europe, a crisis in the Middle East, a conflict in East Asia. Any of these can trigger dollar inflows that hollow out the purchasing power of currencies in countries that aren't even geographically close to the conflict. Turkey saw its currency lose roughly half its value against the dollar between 2021 and 2023. Argentina, Pakistan, Sri Lanka, Egypt, all experienced currency crisis in the same period, all of them partly driven by the same chain of events. War, commodity shock, dollar surge, import cost spiral, local inflation explodes. Now let's talk about where we are right now, because the reason this script exists is not to give you a history lesson, it's to explain why the current moment carries a particular kind of financial risk that most people are not accounting for. There are currently more active armed conflicts on Earth than at any point since the Second World War. That is not an exaggeration. The Uppsala Conflict Data Program, one of the most respected trackers of global conflict, documented over 50 state-based conflicts in recent years. Some are small, some are not. Ukraine continues. The Middle East is in a state of volatility that has already disrupted Red Sea shipping, which is the artery that connects European and Asian trade. Taiwan exists in a state of permanent strategic tension that the global semiconductor industry is intimately dependent on. The South China Sea sees regular confrontations. Parts of Africa are experiencing overlapping conflicts that affect critical mineral supply chains. And here's the uncomfortable arithmetic. Approximately 90% of global trade travels by sea. 3 critical choke points, the Strait of Hormuz, the Strait of Malacca, and the Suez Canal corridor, account for a disproportionate share of that trade. A significant disruption to any one of them reverberates through every supply chain on Earth within weeks. When Houthi attacks in Yemen began targeting commercial shipping in the Red Sea in late 2023 and into 2024, shipping companies rerouted vessels around the Cape of Good Hope. That adds roughly 2 weeks to transit times, 2 weeks of extra fuel, extra crew wages, extra insurance premiums, extra time before goods hit shelves. Shipping costs surged. Manufacturers paid more to move goods. Some of that cost was absorbed by corporate margins. Most of it was passed on. You paid it. You probably didn't connect the price of that particular item to a group of fighters in Yemen, but the chain was there. Now let's zoom out even further, because there's a layer of this that most financial commentary doesn't reach. The world spent roughly 75 years building a system of economic interdependence. The theory was elegant. The more countries trade with each other, the more they depend on each other, the less incentive they have to fight each other. Commerce as a substitute for conflict, economic integration as a form of peace treaty. It worked, more or less, for a while. But something has changed, slowly and faster. We are entering an era of deglobalization. Countries are deliberately reducing their dependence on each other. The United States is bringing semiconductor manufacturing home through the CHIPS Act. Europe is trying to reduce its dependence on Russian energy and Chinese industrial inputs. China is building domestic alternatives to Western technology and financial systems. Countries are stockpiling critical materials. This is rational. It is also deeply inflationary. The globalized supply chain was cheap because it found the most efficient producer of every component and routed everything to them. If Vietnam makes shoes most efficiently, we get shoes from Vietnam. If Taiwan makes the best chips, we get shoes from Taiwan. If Ukraine grows wheat efficiently, we buy Ukrainian wheat. Reshoring production, building redundancy, insulating supply chains from geopolitical risk, all of that adds cost. It removes efficiency by design. The whole point is that you have a backup even if the backup is more expensive.